Welcome back to another episode of Sick Investing with Arya. I don't waste your time, so let's get straight into it. Ladies and gentlemen, it is official. Visa and Mastercard are going to get disrupted. It's over for them. If you're not following the news, earlier today, Amazon and Walmart, on a exclusive article from Wall Street Journal, came out and said that they are exploring the possibility of having corporate stable coins, like the cryptocurrency, in order to be able to do their transactions. Now, of course, it's a big deal because retailers such as Walmart and Amazon combined are doing north of $1 trillion of revenue per year. And then actually in the case of Amazon, in terms of the gross bookings value, because they don't report the third-party sellers revenue as the total amount of money exchanging hands, they just report it as what they charge the sellers. I would assume the gross booking value of the stuff that is being sold on Amazon is probably approaching $1 trillion in of itself. And so, of course, with the introduction of stablecoins, if more retailers start adopting these technologies, that could spell trouble for a Visa or a Mastercard that at the end of the day is only doing about $10 trillion of payment volume per year. All of a sudden, it starts to add up, and it could be a negative headwind for those businesses. And so with that, the shares of Visa slid about 5% earlier today. Shares of Mastercard were down, I believe, about 6 or 7% as well, 5%. And so in today's video, I kind of want to highlight what Amazon and Walmart are specifically doing, because I think there's a little bit of haziness going on with what even is a stable coin to begin with, but then by extension to that, how are they going to actually implement this into their businesses? And then the more important question, what does this specifically mean for a Visa and MasterCard? And I'll kind of spoil it a little bit for you ahead of time, but the answer is not much. Given the dynamic of where Visa and MasterCard sit in the global commerce ecosystem, I highly question the legitimacy of Amazon and Walmart being able to pull this off, but then by extension to that, any form of payments outside of the payment rails. But before we get into all that, I want to give a quick shout out to FinChat.io, which is the world's greatest stock research platform built for fundamental investors, and it's a product that I personally use on the channel here almost every day. And so as I mentioned a second ago, talking about the payment volumes of both Visa and MasterCard, the beauty of FinChat is that not only do you get the traditional financial metrics and the cash flow statement and all the basic stuff that you're used to, but in addition to that, you have a segments and KPIs tab, which is uniquely aggregated on over 2,000 different companies internationally. And so in the case of a MasterCard, you're able to come down here, you're able to scroll down, and you're able to find the total transaction volume. And of course, that's going to be populated on a beautiful charting interface. From there, you're able to draw insights and be able to see that MasterCard is doing roughly $10 trillion of transaction volume annually. This figure has grown at about 8.5% over the past decade, so on and so forth. You could compare it with Visa. You guys get the idea. Thank you for FinChat for sponsoring today's video. The link to try them out with a 2-week free trial, no card required, is in the description down below. Now moving on. Specifically in terms of what Amazon and Walmart are doing. Earlier today, it was reported that they're exploring corporate stablecoins as a customer payment option. The move toward issuing their own cryptocurrencies could potentially reduce billions of dollars for the retail titans that they pay in transaction fees. Stablecoins are a type of cryptocurrency directly pegged to another commodity, which is it's usually just pegged to the US dollar. And so the idea with that is that it would prevent the swings that you see with the normal cryptos like Bitcoin and Ethereum and all that type of stuff. And so why it's important is because if a retailer such as Amazon would be launching its own stablecoin or accept existing ones at checkout, it could operate a payment system removed from the traditional bank and credit card providers that would potentially save billions of dollars in fees, including interchange fees paid to Visa and MasterCard. And then in addition to Amazon and Walmart, Expedia has also explored this. I believe I saw something on Twitter about PayPal actually launching their own or they've had their own stablecoin for a while, but it's starting to pick up momentum with all these different companies either launching it or starting accepting it and all this stuff. I have a sense it's a bit more headlines than actual material impact to the businesses, but anyways, I digress. And then there's a legal aspect to it as well. So the Senate has this Genius Act, which they initially passed it, but then apparently there's another procedural vote for both chambers of Congress that they have to agree on. This is above my pay grade, but apparently it's like partially passed. And so there you have it. It's a pretty straightforward thesis. You know, Walmart and Amazon, they're paying, out of that 3%, only a portion of it goes to Visa and MasterCard in specific, I think about 1/10 of it. But still, that's 2 to 3% usually off of the gross revenue amount that these companies are generating. They have to pay in credit card fees. And for a business that has gross margins of about 10% to begin with, I'm saying the retail portion of Amazon, it definitely leaves a dent in your wallet to be handing over 30% of your gross profit in credit card fees. So from an incentive perspective on the side of Amazon and Walmart or whatever other big retailer or merchant for that matter, totally makes sense. Of course they want to lower these fees. But there's a very small problem. There's a very small problem in that equation. And that problem is the fact that there isn't only one party involved here in a credit card transaction. There's actually technically 5. And so what's beautiful about Visa and MasterCard and the moat of these companies is that it has been created over 5 decades. And the moat is a 5-sided network effect, meaning that there's 5 parties involved. And for the most part, all of their incentives are aligned for this network to exist. So I'll go through and highlight it for you. And I know you guys absolutely love my painting and my drawing and stuff like that. So anyways, we'll do party number 1. This would obviously be our bank. So this is the bank that you go to and they issue you your credit card. And that's how you got your credit card. Party number 2, you might have guessed it, me. Again, pretty straightforward. I think we're following so far. Party number 3, that would be the card network. I'm going to actually turn this into red. So I'm going to put an M for MasterCard. I'm going to do a blue for Visa. Party number 4, on the other side of that transaction, it's wherever you, the consumer, you're walking up to Walmart or Chipotle or whoever. It doesn't matter. Any merchant, anytime you go and you're transacting at a business, they're called the merchant. And so that's the party that's accepting the payments. So I'm going to put merch, short for merchant. And then party number 5, a bit out of sight, but again, it makes sense. It's the merchant's bank. So I'm going to just put down MB for merchant bank, right? Pretty straightforward. We have our bank that gave us the credit card. Obviously me, the network in between us that's connecting the 2 transactions. The merchant, the person we're paying. And then of course, the merchant needs a bank for that money to go into their bank. Now, when we're talking about Walmart and Amazon, at the end of the day, we're only looking at item number 4 here. We're only looking at the 4th party that is involved in this entire transaction. And so it is ultimately in their interest to actually accept digital payments. There's a lot that goes into it. It's a lot more beneficial. There won't be any errors. You don't have to hold cash that would later have to be deposited. There is no security worries about it. And especially back in the day, compared to like checks and stuff like that, it was a lot cleaner method of transaction than the alternatives when credit cards were initially sort of getting rolled out. Now, as it stands today, they've raised credit card prices, the credit card take rates. And so it's becoming a more pronounced problem for the merchant where they're seeing like, hey, this is just seriously eating into our costs. We should definitely look to do something about it. And so that's why they're looking at items such as the stablecoins, because in the perspective of an Amazon, in the perspective of a Walmart, it completely solves the problem for them because it's going to be cheaper fees to do the same transaction. But the issue is, again, there's 5 parties involved here. So let's just ignore Visa and MasterCard because obviously we know where their interests lie. Merchants Bank, again, under this scenario, I'm assuming that money ends up in the merchants' banks anyways. So again, we can ignore them. They'll just do whatever the merchant does. But then we're left with a very important, a critical component of this entire process. You, the consumer. And so ultimately, what is your incentive as the consumer? You who has a American Express Cobalt card, and you're getting 4% cash back on dining and grocery. What is your incentive to put that American Express that you're paying an annual fee for? You've used it for multiple years. You know your way around the app, and it's solid. You've had a great experience using that credit card for multiple years. Built your credit score, everything. What is your incentive to effectively cut that credit card up and pick up some ambiguous digital payments that Amazon's trying to shove down your throat? You don't really know how it works. Do I need to get an app for it? What if the payment goes through? What if there's a fraudulent transaction? Who would I even take that up with? Does that go through Amazon? Right? So just so many questions because there's ultimately actually switching costs to the way the system exists as it is today. And don't think about me and you well, I'm assuming you listening is like a younger person, but don't think about like the younger crowd of like, we're like tech savvy, quote unquote people. And like, we'll figure it out. I'm thinking about my mom. There's no chance my mom's going to be able to figure out how to do she doesn't even know what a stable coin is, right? So again, huge problem in terms of incentive alignment. If you actually listen to, I have their poster right back there, Acquired Podcast. They did a great episode on Visa. And by the end of it, I think the last hour, they're talking about, this is just a masterclass on incentive alignment. If you pull on too many parties within the network, odds are it doesn't end up working out for another party in the system, right? So anyways, that's the situation there. Ultimately, the reason I don't hold MasterCard shares anymore, by the way. So I'm not sure if you guys caught the video or follow me on Twitter or whatnot, but I did sell it, not because of these reasons. I sold it, I think, about a month ago. And I talked about that in a different video and a Twitter post. So I'll link those things in the description if you want to go read it. I don't want to re-explain it here. But yeah, I sold it. I bought Fiserv, which is a adjacent business, not the same. The idea is much cheaper valuation for similar to same growth and also benefiting from the same secular growth trends within the industry. So that was kind of the pitch with it. And I did say if there's a point in the future where the valuation between the two come closer together, so Fiserv re-rates back up, Mastercard re-rates back down, I'd have no problem switching back because ultimately Mastercard is in fact the better business. One other thing, because I know I'm going to get comments on it, people are going to be like, oh, well, Arya, what is the incentive of somebody using a cryptocurrency instead of a credit card? Some people actually just hate credit cards, so they'll just jump on the bandwagon of any opportunity to take a dump on Visa, Mastercard, and that type of stuff. But anyways, that's a whole nother thing. But what is a consumer's incentive ultimately to start using stablecoins? Oh, well, they would offer you cash back. Okay, sure. How much would the cash back be? Well, they would give you a 1% cash back, just like a credit card. Okay, no problem. Where's that money coming from? Right, so they would discount it from the merchant because that's how it is currently done. We're definitely not going to be charging the consumer because nobody in their right mind would be paying 1% to be able to buy something from a business. Yeah, so we would have to charge it from the business. Well, you're kind of just reinventing the wheel there, right? You're charging a cashback. You're giving a cashback to the consumer and you're charging the merchant for it. Odds are you're not going to be able to charge a competitive rate from the merchant to be able to give back to the customer. It's just not going to work. And so one last thing I'm going to do at the end here, I would like to highlight the legend himself, Chamath. I'm not even going to bother saying his last name, but I'm using this as a point of like, if you are, like new to the stock market or for some reason, like you weren't following these stocks back in the day. I say back in the day, it was like 3 years ago, whatever the case may be, or you might have even forgotten, but this thing generally happens every couple of years. The whole crypto talks, and it's going to disrupt Visa and MasterCard. This is finally the year that the global payments ecosystem is going to be shaken up. I think people are just trying to have fun, and it's always fun to kind of go with these narratives of like, oh, this super big company, it's finally the year. They do this with Google all the time. It's finally the year. It's going to get disrupted. It's going to zero. But anyways, I want to use this as a point of like, look at how convincing he sounds at the start of 2022, and look at what he says in plain English, super direct.
My biggest business loser for 2022 is Visa and MasterCard and traditional payment rails and the entire ecosystem around it. So I think that this is the year you can put on what probably will be the most profitable spread trade of my lifetime, which is to be short these companies. And that anybody that basically lives off of this 2 or 3% tax and be long, well thought out Web3 crypto projects that are rebuilding payments infrastructure in a completely decentralized way. If you read the white papers of these,
the most profitable spread trade of his life. That's what he said. The most profitable spread trade of his life. Now, let's see the performance. Let's say you saw that clip. You're like, oh my God, this billionaire, he knows more than me. He's a great investor. Look at all these SPACs and IPOs that he's done in the past year that have done unbelievably well. Let me follow his ideology. Let me sell my Visa and MasterCard shares. And you know what? I'll put it into something safe. We'll do the S&P 500 because, who could ever go wrong with the S&P 500? No problem. If you had done that on the day that he recommended, because it's the most profitable spread trade, never mind had you actually shorted it, but the performance of Visa and MasterCard is more than double. Both of them. It's more than double what the S&P 500 has done over the past 3 years. And my guess is this is not going to reverse course. I think from here on out, Visa and MasterCard are probably going to outpace the S&P 500 because it's just the fact that Visa and MasterCard are a superior business growing at double the rate than what is the weighted average of the S&P 500. The S&P 500 grows earnings per share by maybe about 10%. Visa and MasterCard, you're looking at, well, MasterCard in particular, you're looking at the mid-teens to high-teens earnings per share growth rate, and there's no signs of slowing that down. And so there you have it. Hopefully I gave you a pretty decent overview into the current state of Visa and MasterCard. If you own shares, I wouldn't read into this too much. At the same time, I don't really think it is that great of a time to be buying either of these. I'm able to pull up the historical PE of MasterCard over time, and it's not a particularly attractive time. It's about the median PE over the past decade. So I'm sure had you bought every time it was at the median PE or below, you would have absolutely outperformed. But this isn't an area where I start thinking I have to get into this company. When I actually started my position in July of 2024, it was trading at a low 30s PE. It was a 34, 35 trailing PE. So, slightly better. Call me greedy, whatever. But I'm going to wait for a better valuation in the future if I want to buy back into this company. Again, I'm going to remind you, 2-week free trial, no card required for finchat.io with the link in the description down below. You would also be helping the channel out simply by just clicking it. And then, of course, if you have a valid email address, you have absolutely nothing to lose by just trying out the platform for yourself. Thank you very much for watching. Have a great day.